Welcome to episode 65 of Real Estate Syndicated Live, and I am super is probably an understatement this time. Super excited to have Charlie Koznick in the house. Charlie, as I've been talking about you all week, is Ken McElroy's Chief Investment Officer, meaning he is the guy who's in charge of doing all the due diligence, underwriting, and figuring out what properties Kenny and, of course, Ross are going to do. So, Charlie, thanks so much for joining us. I know you're super busy these days, so thanks for coming on, buddy.
Thank you, man. Thanks for having me on.
You come from a really interesting background, and we were just joking offline beforehand that you started off in an acting career. So I know you've got some crazy stories on when it comes to the acting stuff. But let's fast forward right to your real estate career, because you have this interesting position of having, well, first started with Kenny at some point, but then you went to work for a company where you were involved in basically growing that company from 18,000 units. By the time you left, you guys had 50,000 units, right? Talk a little bit about your background and how you ended up back with Kenny.
Yeah. So, I did some office and some single, triple net lease deals. And that's kind of got my feet wet in the real estate business. And then I got an opportunity to meet Ken, and I came to work for him as the director of his acquisitions for 4 years back in the late 2010s. And then an opportunity came to go. I went and then worked for a year for a wonderful developer here called PB Bell. They were great. They were just kind of in a transition period and we're not really acquiring. So then I went and moved to a company called S2 Capital with Scott Everett out of Dallas, and I ran the Southwest for him. There's three of us in the act department for the country. And that is where, that was a really well-oiled machine. We bought a lot of units, and that's the one that we took from 18. I think when I got on, it was like 17,000. When I left, we had purchased 50,000. I think 45 or 50,000. It was a lot of units, and they were great. And then that kind of gave me the background and the experience I needed. Then Ken and Ross came back to me end of last year and asked for me to come back home as their chief investment officer and run that department for them. And it was an opportunity I couldn't pass up on.
No, that's great. And it's just been awesome to spend some time with you as well. We just had some fun times at Limitless about 3 weeks ago. So
yeah,
you did a podcast actually with Kenny about 6 months ago, I want to say, and you guys were doing the baseball analogy and say, hey, where are we in today's market, right? I think Kenny's been talking about it being somewhere in the second or third inning of where we are. So there's still a long way to go before we kind of get out of this. And you were more in the 3 to 4 inning about 6 months ago.
Yeah.
Where do you think we are today? Do you think we've moved on to fourth or fifth inning, or are we still kind of stuck in third or fourth inning? Give us kind of from your perspective where we are in today's market.
So I think we've moved on, right? So when we talked last time, nobody was saying they have issues and everything's fine and rates are going to come down really soon and we're all going to be saved. I think we've now moved. We're starting to see people, and the people that were selling or we were transacting were deals that people bought a while ago. They had, super low basis, and there's an opportunity for them to take some chips off the table. And that was kind of the seller that you had. They weren't super motivated enough if they wanted to just de-risk a little bit. Now I think we've moved into the phase. You're starting to see people who are going to start selling deals where they're not underwater yet in terms of their loan to value, but they are wiping out equity as they're selling. So that's the next phase that we're in. We're starting to start to see those deals trickle where that sponsor doesn't want the mark on their credit of the default, and they're pumping money into this and they don't want to do it anymore. And so they're dumping a deal, and their loan on it is worth $55 million and they're selling it for $55 million. That's kind of the phase we're in. And I think then the next hurdle will be beginning of next year, maybe the tail end of this year, but beginning of next year through the end of the year will start to be those people that it's, they're underwater on their loan as well. And it's just going to I think it's going to be pretty ugly.
Ugly for sellers, but good for you guys.
Yep. Yeah.
Yeah, I got to give you credit because I think you guys were doing sort of that prediction of what the next phase was. And you were literally saying that, I think you said two things. One, that you were expecting to see some distressed product coming on. These debt payments were coming online and there was just no way they were going to do it. Yep. Obviously, that's been in the news actually quite a bit. A couple of guys out of Houston having some issues, and I see it all the time.
Yeah.
So,
that guys that came out this past year that had issues, they also were just not good operators that were, not taking care of their properties. I saw some of those photos of the not to be named, but it was pretty rough, right?
Right.
I think you're going to unfortunately start to see some guys that are, it's not at any, they are good operators. They're doing what they're supposed to do. They're providing a good living space. It's not like they're slumlords, and it's just interest rates at 8.5%. I mean, you got a rate cap, but even then you're still in the 6s and, 7s. And it's just, you bought it when your rate was 3. Like, that's just really difficult to manage around. It's just very, very challenging. And so the less floating rate debt you have, the better off you are right now.
Did you ever think, Charlie, that back then, like if you think about, 18 months ago, or maybe not even that long ago, when interest rates were at 3, I think some people even sub 3, but whatever, 3, 4. Did you ever think that when the Fed started raising that you'd get this high and you'd be looking at 8% interest rates? Was that a complete shock to you, or was this like, oh, well, this is in the realm of possibility, so we work around that?
That quick and that high was not in the realm of possible. I mean, I'm especially with what the Fed was saying, right? What they're saying, you kind of take them at their word, and no, it wasn't going to be this bad this quickly. I think in hindsight, right, when you can look back at it and Monday morning quarterback it, you pump $6 trillion into the economy, you're going to have inflation that isn't going to just be a blip or temporary. So, where I've been, the previous company I was at in here, everyone saw rates increasing and was prepared for that, but I don't think anybody predicted, March of 2022 when this all started to unfold, that 18 months later we'd be at 8.5 on floating rate stuff. It's crazy.
Yeah, it's crazy, and I'm sure you've had the same issues with your rate caps and the cost of that all stuff. And it's been no fun.
Hey, if you guys have operators that care,
Yeah, for sure. Hey, if you guys have specific questions, I got a bunch of questions for Charlie, but I get to spend a little bit of time with him, so this is really for you guys to ask your questions. Paula, thanks for the thank you. Really appreciate you being on. And you also mentioned, Charlie, let's talk a little bit about, because I think this is an important point, especially where you work. 'Cause I mean, you guys buy primarily, I was thinking of you guys buying like B plus product, right? You're not A pristine.
Oh no, we're going there.
You're going there.
Oh yeah.
The flight to quality. Are you doing the flight to quality? Talk a little bit about that, because I think it's going to tie into my question about the institutional investors, because I know you've been talking a lot in the past that institutional guys are kind of out right now because they're trying to clean up their
on the sidelines.
The balance sheets are a mess, so they need to clear that off those books. And so right now there's no institutional guys in here. Nope. But you think, and I think you're not that you have a crystal ball, but you think that once these guys clear the books and they start getting back into it, correct, their money's going to start going to sort of quality, which I guess you define that as brand new construction, A class. But talk a little bit about that whole concept, because I think that's interesting about the flight to quality.
And listen, it's a really interesting thing that I have had some conversations with bankers before, right? That clearing of you're writing stuff down, that usually happens in large chunks, because bonuses for those major corporations are based off how they do. So if they spread it out over 3 years, they've crushed their bonuses for 3 years. But if they do it all in 1 year, they've crushed the bonus for that year, but then next year there's quote unquote growth and they're doing better. So when you start to see it from the big boys, you're going to see it in big, large chunks. It is not a slow bleed. They try to do a bunch at one time and then they can bonus themselves better. Listen, there's distress coming. There's oversupply. We're just a believer at this point of, if you're going to buy something, I think that the fall for the B space distress is going to be steeper, longer. And I would rather be if I have to buy something distressed, I'd rather buy something distressed that has less deferred. And I think that's going to bottom out less and spike back up quicker than in the really rough stuff. Because we saw some really big increases, and I'm trying to figure out who the buyer is in a 1978 product in a C neighborhood. That's got to go for where that pricing went in a lot of these Sunbelt markets and coastal markets. It ballooned high enough that it started to get outside of where rents were based on demographics and household incomes. That's got to, if I'm a buyer, that's got to be a really sweetheart deal if I want to pick up something. So I just feel that you can get into a space right now in that Class A space that normally syndicators don't get to play in. And so because the returns are so compressed, non-refundable is so big. Institutional wants to sell the institutional because they can buy it all cash if they have to. It's just a space as a syndicator you don't get to play in very often, and you don't need to buy at the very, very bottom. Especially if you're going to be a long-term holder. You just, if you look at some deals that are trading now, they're already down like 100 something grand a door from the peak. So it'll move back up. You may buy, and then 4, 5, 6 months from now, it's maybe a little bit lower, but you try to time that and you're going to miss that window of the opportunity. And so I would rather, get into an opportunity, because once it bottoms and starts to creep back up, you're going to get all the institutional guys back in. And then they're going to come in with their big heavy hammer and outbid you and take their 7 IRRs and 4 million non-refundable. And, oh, don't worry, I'll buy all cash. I'll close in 10 days. And you've missed that opportunity for a 10-year hold on great product.
Yeah. And then, so does that mean, this is news to me, does this mean you're giving up on the BB pluses?
No. We're going to take a break on some C stuff.
Okay.
But yeah, I think there's some good quality B stuff out there, but it's got to be something that's really well. I wouldn't want to go buy like heavy deferred B stuff right now. Cause you're going to end up owning it for a little bit. Like, I don't think if you buy now, you're looking at like a 24-month burn and turn like you were in 2020 and 21. So it's got to be something that if you are, I don't want to say stuck, but if you end up holding it longer than your pro forma, is out, you want to be happy owning it, not stuck with it.
It's funny. I think you're saying something similar. We had my good buddy Alex Kogan was on a couple of shows ago, and he got a little bit of slack because he made a comment about C class and where not that it was dead, but it was just really difficult C class right now, because if you're C class value add, because it's just really tough to you've got to push those rents. People are already kind of at their tipping point, and it's just not as easy as put the money in, put the capex in there, jack up rates, and with cap rates going in the wrong direction, right?
And right, we got to a point where it felt like in certain metros, every cap rate, there was no distinguishing between A, B, and C cap. Like, you wanted to buy a class A, you were not getting a huge, or buying a class C, you weren't getting a huge discrepancy between the cap rate you're paying and the guy who's buying the A class property, right? So when everything normalizes out of what we just came out of, the C has to climb a lot higher in that cap rate, right? The A's were, you bought an A at a 3 cap, and it's going to settle at a 4.5 cap, right? When you come out of this, okay, right? That's kind of the average 4 to 4.5 of class A is over probably the last, 7, 8 years, right? That's a lot shorter gap to normalize than I bought a C at a 3 cap, and it really is probably a 6.5, right? So you got to go twice as far on that to get back to normal. And I think that's where you're going to get the lag. And then you just, again, if people are burned on this in that space, who's the investor and who's the buyer? Who's your buyer pool when that on the beginning part of that climb out? That's all.
Yeah. Paula, thanks, Paula. Paula was commenting that she was emphasizing that prices must come down if we're expecting rates to continue to go up, even if it's 1 or 2 more times. Do you still think prices are coming down? I know 6 months ago you said, yeah, there might be a couple legs more down, but certainly not another. Back then, I think still we're down maybe 20, 25, in some markets, 30%. Do you think we're kind of approaching the bottom as the Fed, at least, is allegedly getting to the top of their rate cycle?
I think we're closer to the bottom of what we're penciling. I don't think we're closer to the bottom in terms of sales comps, because there's just not enough transaction volume. So I would look at stuff we sold that we not sold, but we looked at stuff that we were trying to buy 6 months ago. And I think there's a between those sales comps and the sales comps we're going to see in 6 months from now. Yeah, I think there's still some drops coming for sure. Right. Because as more product comes on, the buyer pool, which is already a little thin, gets thinner when there's more deals on the market. So it's just an odd space because we just don't have a ton of sales comps. So, and when you don't have a bunch of product on the market, right? It's the same thing with housing right now. So everybody bought when it was, 2 years ago, and you could get a 30-year fixed at 2.8%. What you would take the 30-year fix? Why would you take a 7-year ARM that's only saving you like 20 basis points, right? You did the 7-year ARM back in the day when the gap was really big, but now it's like, why would you not take the 30-year fix, right? So now you have all these people that are not going to move, because why would you move out of a 2.8 into a 7%? You've lost all your buying power. So the prices in that housing market and the middle to upper echelon haven't really changed because there's no inventory. And that's kind of the same thing now. There just isn't a ton of inventory that's on the market. So prices are still, your sales comps are probably higher than they're going to be when you see the flood of product hit the market. But it's not changing what we've been underwriting values at, right? Because there's certain deals we just aren't close on. I think when they get close to the number we're underwriting at, then we're at the bottom. Does that make sense?
Yeah, 100%. And that's a good transition to, you mentioned things penciling out in your underwriting. I mean, you're obviously extremely experienced in the underwriting world, and we've got a lot of it in our community. We have a lot of syndicators who are just starting in multifamily. We've got people in the middle. We got, really advanced folks. So I kind of want to make sure we address all of them, but can you walk us through on the underwriting? I mean, can you walk us through, I mean, obviously I'm not looking to look at every single cell of your model here, but can you kind of walk us through your approach to underwriting and what are the sort of some of the things that you look at when you're trying to make these things pencil?
Yeah, I think there's a science and an art to it, and you got to kind of blend the two of it. So on the art side of it, listen, everybody in their a vast majority of people in their life have rented at some point in their life, right? So you walk a deal and view it as a renter. It may not be in a neighborhood or a product that you would live in, but you understand floor plans and the flow of a deal and the amenities and how it sits and would you want, if you were in that position or wherever, would you want to be a renter here? I think that's a really big deal. And I think, neighborhoods, a lot of renters, to get the best demand, you got to be usually in neighborhoods in which people want to be in, but they can't afford the housing in the neighborhood, so they rent. That's a great demand driver in my book. And then kind of, we'll go tour deal, or if it's off market, we'll go secretly shop it. And then you kind of just plug in what you think you think you can operate it at. And then you survey all the rents around you. I tend to try to do a year or two, like if untrended on my renovations. So if you think that the neighbor is at, $1,800 for a 2-bedroom, I'm not going to put in, we're going to get 1,800 and then also grow it from there. Right. So it gives you a little bit of a buffer on that. You just got to make sure, now we have an advantage in the sense of when I was at S2, it was 35,000 under management or 30,000. Here at MC, it's 8 to 10. So we have a huge, data source for what we run stuff at, right? So it's much easier to say, hey, I'm going to plug in there's the stuff I control and the stuff I don't control. So I already know my uncontrollables, taxes, insurance, all those stuff. I can plug those in. And then the stuff I do control, payroll, admin, marketing, I have a huge data source of what we can run it for. So I don't really care what anybody else is running it for. It's what we can run it for. Maybe you take into account kind of what the other person's doing on R&M and look for errors, but you're pretty efficient at all three places I've been at that in my multifamily career. There isn't like an anomaly. We all they all run our deals at the same repairs and maintenance. We all do the same inside of that context of that company, right? So that helps with the underwriting. And then you just got to listen. I think the biggest lesson I learned over the time in this is that I always tried to make decisions with like 100% of the information. And if you wait that long, you have absolutely missed the deal. And so my new theory is if you make the decision before you have 60% of the information, you've made the decision too early. And if you make the decision after you have 85% of the information, you've made the decision too late and the opportunity will have been taken by somebody else. So you got to put in your numbers, what you believe in. And then honestly, if the numbers pencil and the numbers make sense, then you have to just pull the trigger. I have underwritten myself out of too many deals in my life. I start off in versions 1 through 10, the deal totally pencils. And then I find myself in versions 11 through 25 each time going, well, that could go wrong and that could go wrong. And then I stress test it into the ground. And if it doesn't survive the apocalypse, I don't want to buy it. Right. So,
but you don't do that on every single deal, right? I mean, I think on most of them, you're looking at it and you're probably saying yay or nay in like 30 seconds.
Right?
No,
right.
So
this is when you're
like
down the road and
right.
Your first pass, there's just on the 30,000 foot view, I can say yay or nay pretty quickly within like 5 minutes, just based on location and knowing the submarkets we're in. Then you do a quick back of the cocktail napkin, yay or nay. Then you can do a first draft of underwriting, probably takes 30 minutes. And then if that pencils, then you start, digging in and getting more and more versions. I don't get to version like 15 until we've been awarded the deal. So
how many versions have you done? What's your record?
I think my record's 23 versions.
Wow.
Well, once you make one tweak, right, you got to save it. So,
and talk a little bit about sticking to your guns on your model, because a lot of times I feel that some syndicators, things aren't penciling, and so they start tweaking.
That's bad.
Tweaking their model, right? Talk a little bit about that. Like when you say tweaking, you're not messing with your principles or whatever your strategy is on underwriting rent growth, or you don't mess with that, right? Or you don't change that based on the market?
Well, right, you tweak in. Right. Maybe if we offer a valet waste program here, we can pick up $12 unit. You can do the small little tweaks in there and things you're going to offer that are tangible, right? You can't just make them up out of thin air and say, oh, by the way, my payroll is 18, but I really want the deal, so I'm going to underwrite it for $1,300, and I will somehow figure out how to do this deal without a maintenance guy, right?
But I can mess around with the rent growth. I can say, well, instead of doing 2% rent growth, man, things have been going really well in 2020, 2021. I'm going to put 5% rent growth, and that'll change everything, right?
No, that changes everything, right? It's like that's pulling levers, pulling one lever. Fine. You start pulling like 5 levers. It's you've put yourself into a precarious position. So listen, you just don't want to put yourself in which I've watched when there was a big buying spree going on in 2021 and stuff didn't pencil. And then all of a sudden, all these groups were buying stuff, right? You have to catch yourself being like, well, what am I missing? That's where you start to get into getting outside of your norms that you shouldn't get outside of in your morals or your compass on what is attainable, right? You just have to stick to what you are. And if the deal pencils for you, great. And if it doesn't, you just need to move on. Where you can start to kind of maneuver some stuff and say, hey, maybe we can offer this service, or maybe we put a cable contract in, or things like that is if it's really close and you kind of just want to give it, you can find something that maybe helps it out, but you have to be offering something for that service, right? It's like, hey, maybe we can move rent growth a little bit because we'll put in a different gym set or something. You can't just arbitrarily say, oh, by the way, we're going to move rents an extra $50 because I need to.
Right. And that's why it's so fascinating to me. And by the way, if you have questions, drop it in the chat. And if you're getting any value from this, make sure you hit the subscribe and the like button. It really helps us out. And we can get some more amazing guests like Charlie. It's always fascinating to me, Charlie, because I literally have, I don't want to say 50-50, but I got a lot of clients who are like, there's nothing pencils out, man. There's nothing out there. We've been looking for a year and a half. There's just nothing out there, right? Yep. And then I have other clients who are just like, boom, boom, just one after another. And it's like, okay, one of you is probably right and one of you's wrong. Maybe not. I don't know. Maybe it's the market. But where have you guys been in the last 12 months? Have you guys been on a shopping spree, or are you having a hard time finding?
We have had a hard time, but we're starting to see some success. So some stuff is starting to come into the zone of where we feel comfortable with it. So we're at the very beginning of that. And we see deals coming, that we think the gap is getting close enough that we feel comfortable pulling the trigger. And we think, again, we're not burn and turn guys. So, we're longer term holds and we're more basis play and not over levered. And we can, own this in cash flow and then refinance and get
infinite,
your cash
infinite, baby, infinite.
Correct. Exactly. So we're a little bit different buyer than a lot of syndicators. I think that's a benefit that we have. There's a lot of syndicators that, I can show you a 20 IRR, but I'm going to own it for 13 months versus I can show you a 13 IRR or 12 IRR, but it's over 10 years. Right.
Right.
And I think some people not being able to buy and others listen, every underwriting I've done, the only thing I do know is the second I'm done underwriting it and we buy the deal, it's going to be wrong. Right. Somewhere in there, no one's can predict the future. So some people could be right and some people could be wrong. I think that's a timing issue. And I think why some people are buying a ton and some aren't is either A, they're juicing things, or B, everybody has different return metrics, right? So there was a group of if you're IRR, if you have an investor that's like, hey, I'm capital preservation, I don't need a ton of, that person can buy a lot more now than the person who's like, I need a 20 IRR. So it all depends on what your investor is looking for to determine if you're actually overpaying for the deal or not, right?
Right. Yep. 100%.
So that they're like somebody that I remember we went through. There was a period coming out of COVID that we bought, and we were at S2. We had a lull, and we're a company that was buying, $4,000 or 4,000 unit portfolios. And we had like a 6 or 8 month lull where the company just didn't buy anything because things didn't pencil. And that was that was really one of the beautiful gifts I got from working there with Scott Everett was, for watching somebody that had a pretty voracious appetite, then also go, this just doesn't work right now. So we're just pencils, we're just down. Like that's a really cool thing to see and have that feeling on that. So that was a great learning lesson for me that you can be both, right? When the time is right, you strike. And if the time isn't right, like there is no pressure. And I remember I had a call and I was like, man, we haven't bought anything for a while. I'm stressed. He's like, dude, just if it doesn't work, it doesn't work, right? Like that's not what we're not here to jam things in.
Yeah, it is harder for some though, in terms of if you don't buy, you're not getting those acquisition fees, right? You're not getting those asset management fees. You're not I don't know. There's a lot of issues, but obviously the lesson here, I think, and I keep hearing this over and over again, is just make sure, I'll use a basketball analogy. Wait till the ball comes to you as opposed to you going to force something, because
correct.
Wait for that market to come back. Do you guys use a proprietary? Eric was asking if you if you underwrite with some proprietary calculator, or do you have your own models? What do you guys usually use? And don't worry, I'm not going to ask you to share it.
No, yeah. We have our own Excel spreadsheets that it's. At all 3 places I've been, it was their own, built internally Excel spreadsheet. So,
yep.
And I've seen them range from, I've seen it done in 10 tabs, and I've seen some with 35 tabs. Everybody's their own, deal. Yeah. But no, we don't use anything we have our own. We don't use a calculator, but we have our own proprietary Excel stuff, spreadsheets.
Yeah. One of my favorite things that Kenny always talks about in terms of the underwriting, maybe for the value add piece, is just finding properties or finding units that sort of have those washer dryer hookups. That seem to be like a nice little way to add a ton of value to a property, because if they don't have washer and dryers, or they have the sort of the laundry mats or whatever, and then you're able to easily come in and attach stuff, which allows you to increase. Maybe that's how you bump up the rents we were talking about earlier, not just dumping it up for no reason, but you're adding value. You're giving them in unit washer and dryers, and therefore you're able to jack up the rents $25 a month or whatever, which then multiply it by the cap rate you're raising. Any other fun sort of things that you look for to sort of add value like that? Off the top of my head, I was thinking of those. I know some people just create parking lots by painting lines on the floor or something. But what are some cool things that you can easily just very inexpensively add, which will add a lot of value to your properties?
Well, real quick, just on the washer dryer one, right? That's a really interesting play.
Yeah.
So the main thing I see on that is, well, first of all, you have to make sure it's doable, right? Can't count the many times you just look in a broker pro forma, like add washer dryers. And then you actually have to go walk the units, and where would you put them? And then once you find where you want to put them, is it even feasible then to put them there? I've seen some people, they're in it's a 1-bedroom and they're in the closet, and the closet isn't even a walk-in. So it's like sticking out of the closet, and you've now taken away all their places to hang clothes. And now it just kind of defeats the purpose of having a washer and dryer because they have no store. It can get I've seen some very interesting washer and dryer placements. It can get very expensive if you don't know where you're going to put them and how you're going to run the plumbing. I've seen a wild arrangement of stuff. And I think, the washer and dryer kick is really, really important. I think if you're going to do that kind of full value add with hard surfaces and really spruce things, I feel like the person that's going to pay for the quartz and is going to pay for new cabinet fronts or boxes and, the plank flooring and the bigger baseboards, like that person doesn't want to do. You're going to get more runway on value out of that if you also are then providing a washer and dryer. I feel like the person that's willing to pay for that doesn't have to schlep down with their flip flops and wash their stuff with other people. So you end up, if you aren't going to be able to add washer and dryers, that actually tones down usually what I think I can get per unit if I'm going to go do an upgrade on the interior. You got to kind of add. If you add both, you actually get more juice out of the interior if you can add a washer dryer with it. So other things you can add. Some people are using package lockers. These are bigger places though, right? Where you can charge for those. That's in like a $7 a month fee, but that is little stuff you can pick up. Amenity spaces are an odd one, right? Gyms to me are really interesting. Like I feel like you have to have one. It's an amazing leasing tool. Everyone walks in and goes, "Gosh, that gym's amazing." You have to have it because the guy down the street has it. And the guy's going to pay $2,000.
Nobody uses it.
But nobody uses it. January 1st through like January 21st, it's packed and then it's not used again. I think that's the same thing with pools. Like they look beautiful and you have to have them, and they absolutely help in renting. But then you walk by and like really nobody's sitting there and using them. Yeah. So it's just a really odd space to be in. You got to do it. It does help your rent growth, but nobody ends up actually using them.
Yeah.
So
how do you deal with exit caps? Because that's a big little. That's a big little. That doesn't make. That's obviously a big assumption that you have to make in your underwriting.
Yes.
What especially if you're, and again, you guys are a little bit longer term. You guys would love to keep this property forever, just keep refinancing it. But for somebody who wants to go exit in that typical 5 to 7 years, which has suddenly over the last couple of years has turned into like you said, 13 to 18 months. But somebody wants to do a 5-year exit. Any how would you go about underwriting an exit cap? Do you just go with your standard, 25 basis point per year, or what is it that you would be recommending?
I think the industry standard has always been like 10 basis points per year, but I also think that's just too simplistic for what you want to do, because if I bought a deal in 2022 and was planning to sell it 5 years later, and I bought it at a 3 cap, and I decided that I'm going to sell it at a 3.5 cap, like doesn't work, right? So that gap I think it is more relative to where you're buying the deal and where cap rates have been over, say, a 10 to 15 year period. That would play much more into what I'm going to put as my exit cap than like just the standard 10 basis points. So, if this market continues to go and cap rates go to 7, and I'm going to own a deal for 5 years, and we are in a recession, and I decide to underwrite it out at an 8, like you probably could underwrite at where you bought it or even inside of that, right? The big one I saw was in 2020 and 2021, people were buying 4.75 caps and then underwriting, value adding 80% of the deal and then selling it at the same cap rate. Like it just depends on what you're buying. Like, so just slapping on a 10 basis points per year, I think is just, you're missing the mark. So it's a deal by deal basis, right? If you're buying a Class A deal and you don't have to move it as much, right? Because if it's 2 years old and now you're buying 5-year-old product, it kind of sells in the same zone. Then if you're buying a value add deal and you are going to stabilize it, then you do need to move that cap rate wider, because you bought it at a lower cap rate because you saw a chance to move and have some juice and some meat on the bone. And the next guy is going to be buying 1984 product with, if you renovate the whole thing, no meat on the bone. So why is he going to have the same yield as you? So those are the ones you got to spread probably even more than 10 basis points a year.
You mentioned earlier, this is probably good, something about untrended. You threw out the term untrended. We had a great question from one of our community members in our Facebook group, which I'm going to put on the screen there for you guys. But I'm just going to read it because it's a little bit, it's like a paragraph long, but I think it's a really interesting one. It says, a very few of today's multifamily syndicators ever mention untrended yield on cost. Untrended yield on cost. In my opinion, this has made it easy for the poor quality syndicators, whoever they are, to continue to raise money for bad deals by jacking up leverage and inflating growth rates to make the returns look good. I'd love to hear what someone like Charlie, who has the experience, what does he look for in this metric for value add deals? Can you talk a bit about that? And should more syndicators be looking at that metric?
Yeah, 100%. So it's a great question, by the way, and actually incredibly insightful and absolutely 100% true. So the yield on cost part is really interesting, right? Because everyone's like, hey, I bought it, especially in the value add space. Like I've seen some people come back and say, the market's moved, but we bought this for, I'll just make up a number. We bought it for $35 million and now it's still worth $50 million. So we're up $15 million, but that's not what you bought it for. You also put in 25 a door on the interior and 10 on the exterior. So you're actually 35 a door inside. So now you're not actually saying what your full cost is. You're trying to say, hey, look how much value we created off your purchase price. And that just gets lost. And I think you can catch a lot of unsophisticated, I don't mean that in a derogatory way. It's like, there's a lot of people like, I want passive income. I'm relying on you to be a fiduciary and I don't understand this. And so you say I bought it at $200 a door and it's now worth, $260 a door. So don't worry, or $250 a door, we're okay. But you're not telling them you actually, put 20, with closing costs, everything, you're actually at $240 a door. So now you really don't have that much equity in the deal anymore. That's really big deal. And then the untrended part, right? If you would have done that and not trended your rent. So what that means is like, I'm going to buy a deal and I think the in-place rents are $1,200. And I think that if I value add this deal compared to the competitors, I can get $1,500 for it. If you were to trend that, you would then take that $1,500 over the next 3 years and you would be growing that on top of the value add you already did. If you wanted to untrend it, you would just say, hey, I think I can get $1,500. What does that look like? And so, a lot of models I work on, I try not to do like the first 2 years to try to do them untrended. That's a really conservative, solid way to go in and say, hey, I think the competitors today are at $1,500, and by the end of year 2, I'm going to be at $1,500. That you can stand on. If you can stand on that, that's pretty good. That's kind of that's a great metric to use it on. Like the first 2 years, just don't grow. You can grow your classics internally if you want to, but to grow on your value add, for the first 2 years, if you don't have to do it, it's pretty good.
Yeah. And I'll be honest with you.
By the way, you would have missed out on it. But also though, right? It's this bizarre double-edged sword. If you would have never trended your rents, you would have all these value add guys would have outbid you like crazy. And then because they did 3%, but they actually got like 12. So
right.
they made like 30x on their money as the sponsor, and you missed out. So
yeah,
you got to underwrite the deal with sensibility, and then you got to believe and like the deal you're buying. I'm a big believer in that. Like it's got to have a story or something else behind the numbers, and then you just bet on it and you go.
It's funny that I didn't even had heard the term before, the untrended yield on cost. So maybe I need to add that to the questions an LP should be asking the sponsors. But make sure you understand what it is before you just kind of pretend.
Yeah, we usually use return on cost, right?
Yeah.
What do you need that to be come year 3? Kind of we that's kind of the year we pencil to want a return on cost, and like now it's higher, but back in the day, in the heyday, we were trying to get to like a 6.5 return on cost by year 3 on our money.
Yeah. Question from Tice. You need to let me know if I'm pronouncing your name correctly. Anyway, not sure if you already discussed this. We didn't. What exit strategies would align best with the potential investment in multifamily, considering the current market cycle? I know it's kind of a vague question, I think, but exit strategies in this market, I presume it's not flipping in 12 months.
No, no. I think there's two groups right now. There's two ways people are financing things. A lot of people are doing, if they're going to go fixed, they're trying to not really do the 10-year, right? Because you just watch rates go up through the roof. And so do you really want to be buying a 10-year fixed at 6.5? And then if a recession hits, that's when rates start to drop again. And now and rents drop a little bit and you're the guy stuck in a 6.5% rate. So I like the fixed play. I would maybe try to do like a 5-year fix with maybe a flex prepay. So you can get out in years 4 and 5 at 1%. So you're getting yourself the security of the fixed, but the flexibility that if in the next 5 years rates do come down, you can take advantage of that. And then you can go into your, somehow miraculously they come back down to like 4.5. You can then put yourself in a 10-year fixed at that and feel really good and hold your long term. That's what I would do. I would plan on holding it for 10 years, but give myself the flexibility to do something with it in the next 3 to 5. I wouldn't ever buy a deal being like, then there's some people that are still buying floating rate debt. They're just buying an in the money cap. They get more proceeds. So it's kind of a wash either way. And they're just betting on the fact that in the next 12 months before that 3-year term is up, they're going to, in that 3-year cap and their 3-year term, it's going to come way down and they can crush it that way. So they're not even betting on anything other than just interest rate at that point. So
That's true. And I'm going to get in a second here I want to talk a little bit about LOIs and also best and final. But before that, let's just knock out some of these questions. And again, if you're getting value from this, hit the like button for me. Really, really appreciate it. Paula asks, isn't it true that your B stuff will become your C stuff after the crash? I guess we're assuming a crash here. And to get it back up to B status, you would have to wait 10 years. What are your thoughts on that?
No. I think I understand what she's trying to say. I wouldn't use that it changes. I just think B stuff will become less expensive, and like the classes don't change, right? A Class A structure is going to be a Class A structure. It's just going to have cheaper rents and lower pricing. So everything will stay in its same class. It'll just take longer for it to get back up to the valuation. Our B stuff won't become our C, but our B stuff to get back to where where pricing went in some belts, it could be. I mean, if it gets back there in 10 years, that would be amazing. That would be even amazing. So
you think it'll take more? You don't think it'll take more than 10 for some of these?
Yeah.
Yeah. Wow.
To get back to where, if you bought at the peak.
Yeah. Wow.
I especially in that B and C space, it got super inflated and people were buying stuff that, listen, I'm invested in a bunch of it, so I hope it comes back in less than 10 years. That would be amazing.
You're talking about people already in, but you don't think you'll have an opportunity to pick them up after some distressed sellers?
No, I agree. I meant, I just meant if you're in it now, it'll take. Yeah. If you bought peak, you're not seeing that pricing for a long time.
Yep.
But I think there's opportunities coming. Yeah, absolutely, in the next 24 months.
Yeah.
So, but I don't think the classes change. The B just becomes a less valuable, less rent collecting B. The classes aren't you can't shift classes unless your actual physical plant and or location changes, right? If the neighborhood goes down the tank and all of a sudden it becomes blighted, then your B becomes a C. But the market, the economy doesn't change that in terms of like pricing for the deal or the rents. That makes sense?
Yep, absolutely. What about the products that are coming online? Thomas asks, any concerns with new competing Class A and B products being delivered over the next few years as shovels are finally starting to break ground in some new markets or in some markets?
Yeah, I mean, listen, supply and demand, that's the name of the game, right? That's why it exploded. We had demand. We had we had 6 trillion pumped in the economy. People had cash in their pockets, right? So the demand
not anymore.
No. So there's going to be competition in it. I don't think there was the end of that question because it was a good one.
Sorry.
No one's breaking ground right now, by the way. That's where I think the kicker on this is going to come in is, I'll give Phoenix as an example, right? We got a ton of units. That's where we're located. We got a ton of units coming online, but nobody has started you had to complete the deals that you already started, but no one's getting new financing right now on construction. Just nothing pencils. And the land guys are like, I'm not selling my land for this. I'll just ride this out. It's just vacant land. I got to pay the taxes on it. It's not really costing me that much more to hold it longer for prices to come back. But there hasn't been a land transaction for multifamily. I mean, it is impossible right now to make anything for new construction pencils. So, right, you can't speed up construction. Like, it just takes a certain amount of time to build a deal. So there's going to be a beautiful period, 2025, 2026, in a lot of these markets where there is just nothing coming up. There's no new deals because there was that lag in right now. Nothing gets shifted to 20 to 24 months from now when those deals that should have been being built right now don't show up. That'll be a beautiful gap in, absorption and pricing and all that stuff.
Add to the already sort of under supply that we already have, right?
Correct.
Yeah.
Yep.
Cool.
And again, it's interesting, right? There's a lot of markets. I think there's going to be supply issues, but you have to start to look at also, there just isn't again, I'll give Phoenix. Phoenix has, I think it's the last check was like 75,000 units in the pipeline, which is a big number, but that's pipeline, right? That's not sticks in the ground. So a lot of those will fall out. And we only have the labor to do like 15 to 17 a year anyways. Does that make sense? So you can't, this big number will take a while. You just don't have the manpower to do it. So.
And the financing, I've been hearing, banks have their own problems right now. The last thing you want to be doing is going on the construction side.
We are all over construction financing, and it is basically a non-starter.
Let's go to best and final because we're running out of time here, and I want to get to this.
Already?
And,
That's crazy.
I
That
know,
was
right?
fun.
I'm having
Okay.
fun. So best and final. This is something that in our community we talk a lot about.
I hate 'em.
You know, lots of obviously, you know, lots of people vying for the same property. You get down to your final 3, 4, 5. Walk us through the process. Let's just start. I was going to say 3, 4, 5. Walk us through what that looks like on a best and final, and then what are your tips or how do you try and navigate that world? Because
You want that from the buyer side or the seller side?
From the buyer side.
Buyer side. Okay. So marketed deal. You know, in the heyday there was like 35 offers a deal. And then now it's 8 to 10 offers. They take usually 3 to 4 groups to best and final. You make that cutoff. They ask you to sharpen your pencils. And you always save a little something in the tank. And then you listen to the broker's wonderful stories of where you need to go to and how much you need to move, and you have to decide if it's in it's like trying to buy something at it's like an auction, right? You have to set a number in your brain, like we're just not going past this, because if they say, hey, it's yours for another $500,000, like, well, then when you get there, could technically be another one, like, hey, they move, so now can you move another? It can go on forever, and you just have to have that I'm willing to just walk from this deal because it doesn't work anymore. You've got to clutter out the noise and make the decision, right? This is where the mental strategy of best and final is a head trip. Is you don't want to lose out on the deal over, I'm going to use bigger numbers because we buy stuff. Let's say you're in on the deal for 50 million and they're like, hey, you got to move. It's like, if I move 250 grand on this, it doesn't really move the returns. So it's just a head trip to draw that line in the sand. And you got to cut out the noise of, when you're in the business, you're getting information from everybody, right? The broker that has the deal, the the guys that are helping you get the debt. Then there's brokers that don't have the deal. They're piping information into your ear. And you have to underwrite to what the deal works for you and cut out that noise. Because I've seen it go, listen, I have been in situations where I have been said, hey, I've been on sides where you're selling, like, hey, listen, you got to move $1 million to buy this deal. And guess what? They were already the highest bidder and they didn't have to move $1 million at all. And then I've also said you need to move $1 million, and they absolutely had to move $1 million, and they didn't, and they lost the deal. And the group A could have not moved the $1 million. They still would have got it. And the group that didn't move needed to move, and they didn't get it, which is why you have to just cut out. It's a total head game. It's not fun. I wish I could be in the brain of every broker and find out what it is and just bid exactly the 100 grand more than everybody else. That's why your principles are super important on and what this deal works for you and your investor base, right? You may pay $500,000 more than the next guy, but your investors, your base may say we need a 12, and you can provide that to them. And you don't want to miss that opportunity to give your investors what is inside their criteria. That's where you got to just stay. As long as it stays in your criteria, inside of your range of what you believe is a good buy with inside your investors' criteria, then push to where you need to go get the deal. And if it gets you there, great. And if it doesn't, it doesn't.
Do you have a range going in, like a price range going into these, or do you have like a bottom? Like, I'm not paying more than in your numbers. I'm not paying more than 51,250,000, because if it's 251, I'm out. Or do you have more of a range, or do you even sometimes go back to the drawing board and do underwriting number 73 when then you and Kenny and Ross all get together again? Going into it, do you have a number, or are you flexible?
I tend to have a number. Flexibility. Here's the best thing. I'm a huge analogy person. My wife is always like, my God, if you give me another analogy. If you go out and say, I am not going to have a drink tonight, I'm driving a car. If you stake that hard line, you're less likely to do that. If you're like, hey, I'm only going to have 2 drinks tonight, and then I'm because that's my limit, I can still drive, the odds of you having that third is much higher. So if you go into it flexibility, it's just a slipperier slope. Does it make sense?
Yeah.
All right.
100%.
Okay. So it just, the other thing, I'm okay on moving and being pushed a little bit if I'm not bidding against myself. If they say, hey, you need to get to this number and the deal is yours, and I got to move, from 5, I said 51,250 and I got to go to 51,5, great. But if they just are saying, hey, you got to move, and I don't know where I could be, it's got to be, they say, if you go to this number, it's your deal, then I'm going to be more apt to get to that number if it's close. I mean, I'm not going to move. If I'm at 50 and like, hey, you got to get to 53, like it's not, or 52.
Is that where the relationship with the opposing, the other broker comes into play, or are you talking to people you've never dealt with before?
Right.
Because I mean, if somebody tells me and then it's yours and you know this person and you trust this person, that would be different than if it was just, I don't know this person from Adam.
Yeah. And again, you won't, yes, it's a relationship. And if it's somebody that you don't know, you go to that number and then they don't award you the deal. You now know that they're not a trustworthy person. You won't deal with them again. Right. Yeah. And it's interesting, right? I think we're in Arizona and Texas. Texas is a non-disclosure state. Arizona, you have to disclose. So the Arizona brokers unfortunately have to be a lot more truthful when they say, if you need to go to this number or the deal is yours, because you're going to find out what, like, let's say you're at 50 and they say, hey man, you got to go to 51 and you don't, and somebody else buys the deal and it was at, you like, I'm out, and somebody buys it at 52.50, they BS'd you. You didn't actually have to go that. I mean,
right.
You get a quicker feedback on the BS meter. Texas, it's the Wild West. So
has it gotten easier for buyers over the last 12 months? Hey Tom, by the way, good to see you. Or good to
it's gotten easier in terms of terms. So the pricing gap is still, I think, wider than we'd like to see it on a vast majority of the deals. Not all of them. There's some sellers that it's much more realistic. It's gotten easier with your non-refundables, your timing. You can now, like, a 60-day close with a 30-day extension used to be like, can you do it quicker? Like, because if you don't, you're going to lose it. Now that doesn't lose you the deal. You don't have to have non-refundable. People are allowing due diligence periods. Back in 20 through 2022, it was if you weren't 7 figures non-refundable day one with basically an environmental and title out, that's your only outs, you weren't going to win the deal.
I remember those days.
No longer, that is not a necessary. So you just don't have to be put yourself out there and exposed as much as you used to. That's the biggest change in your LOIs.
Perfect.
You can compete now.
Let's talk about LOIs a bit, and then we'll do this as a wrap up question here, because this is another thing that any thoughts on the LOI prize, or anything that you guys put into your LOI that you think gives you a little bit of a not an unfair advantage, but something you guys do in the LOIs is different from everyone else? Or do you just, have a sort of your templated LOI, you think LOI is not that important, or are things that you can put in there that'll help you either to get to best and final or ultimately get the deal?
So when you get into the 100 unit plus space, there isn't a lot you can put in it's pretty generic template. That you can, other than non-refundable money. That is the only thing. It's really the only thing people read on an LOI when you get that space. I think if you're in the smaller unit space, there's maybe some things you can do. There's not, it's harder to find out someone's reputation, right? The guys that are buying the 250, 300 units, everybody knows who everybody is. So it's they've always closed. They've never retraded. If you can put things into your LOI, if you're buying 20 units, there's a lot more things you can do to separate yourself and giving that buyer or that seller that more of an assurance that you're going to close. That's the biggest key, right? Yep. Outside of non-refundable monif
Sounds good.
The sooner you can close, more likely you are to buy. Like if you can say, hey, I've lost deals before where it was like, I think we were like on the same price, but we were non-refundable day one. I think we were like $2 million day one with no outs except for environmental and title. And we didn't win the deal because we had a 60-day close and someone paid the same price and had a 10-day close. Or they even paid a little less. And the guy's like, I'll take the less. I just want the faster I can get this money in my bank account, even though we had 2 million non-refundable. Like, we're not walking from $2 million, right? So it's pretty safe unless you saw values plummet and you're like, I'd rather eat the 2, but very rarely are you going to walk from $2 million. But then that guy still would pick the guy that had maybe a slightly less price just because it was 10 days instead of 60. And the sooner you can get it over with, the better.
Yeah, and that's a oh man, it's tough because I'm from my being the lawyer, obviously I'm like, dude, you try and get as many extensions as you can because things happen and sometimes it's not even buyer or seller's fault. The lender or the broker has issues, so we can't close on that day. You want to have that backstop and that extra extension, maybe a second extension. But then on the flip side, so that's from the legal side and your protection side, sort of the more conservative side. But then on the flip side, more extensions versus less extensions gives the advantage to the less extension person because to your point, they want to close, right? I mean, it's just a thing.
And you just put yourself behind the 8 ball when you are the guy that has like 3 extensions and the other guys don't. Like you're just never going to win. So, I think in today's market, you'll have a little bit more flexibility. Like if you got into a deal and you had 60 days of close with a 30-day extension, you got into that and you're like, hey, like I will give you more non-refundable. I just need like an extra 15 days. They're back in the 2021, they'd have told you to pound sand. Now I think everybody's like, listen, as long as you cross the finish line at the price you said you're going to cross at, like I'll help. Like, and I have some collateral back that says I'm going to show good faith that I just need more time. It's just, I'm going to close. I just need a little bit. I think you'll find that.
Especially these days too, they don't want to start the process again, right? They don't want to go all the way back and put it out for bids.
Moved again, right?
Right. All right, my friend. I'm going to echo Craig's comment here, and I appreciate the comment, Craig. I'm glad I tuned in. A lot of great info. It absolutely has been a ton of great info, and I really, really appreciate you, Charlie. I know, first of all, you just literally got back from a little time off there, and I don't know if it's time off. You were in Idaho, probably just getting away from the heat. Yeah, I know you're just back in the office the first week, so I really, really appreciate on my behalf and behalf of all of the real estate syndicator community. Charlie, if somebody wants to get a hold of you, if somebody wants to, get on your list or something, what's the best place people can find you?
For me, if you go to, is it investor related? Is it MC? I should know this as chief investment officer. I did so good this whole time. I wasn't gonna have any mess ups.
Let's go to maybe mccompanies.com is the website. And,
just go to that. And there's an investor relations.
There's an investor.
Correct, and all general questions go through that.
I know. I gotta ask him, and I'm like, but no, it's been such an amazing hour. Everybody, give him a clap in the chat. Really, really appreciate it. Thanks, everyone, and I'll see you soon, buddy. And we'll see you next week, same time, same channel, Wednesday 4:30. We'll see you next week. Thanks, everyone.
Awesome. Thanks for having me, man. That was great.
Yeah, absolutely.